There's an industry in this country built entirely on the premise that you don't know enough to say no. It doesn't advertise itself that way, obviously. It advertises itself with words like fast, easy, no credit check required, get cash today. And it puts itself exactly where people are most vulnerable: low-income neighborhoods, college campuses, tax prep offices in communities that banks walked away from a long time ago. It is legal. It is enormously profitable. And it is not an accident. Last episode, we talked about why nobody taught you this stuff and who benefits when you stay confused. Today, we're going one level deeper because there's something I'm going to show you at the end of this video about why certain neighborhoods don't have banks. And once you see the actual reason, not the excuse, the reason, you're going to look at your own zip code differently. Stay with me. This one's going to make you angry. Good. So let's start with the basics, because not all debt is predatory. A mortgage with a fair rate, a student loan with transparent terms, a credit card you pay off every month. These are tools. Used right, they build something. Predatory lending is a different animal entirely. It's lending engineered so that the most likely outcome, not the worst case, the most likely one, is that you end up deeper in debt than when you started. The hallmarks are always the same: sky-high rates buried in fine print, fees that compound fast, repayment terms that are almost impossible to meet on time, and complexity, deliberate complexity, because the entire business model depends on you not fully understanding what you just signed. That's why these products thrive exactly where financial literacy is lowest. We covered that gap last episode. This is what moves into it. Here's what we're covering today: the payday loan, and what it actually costs by the time it's done with you. The overdraft fee, the one tax you didn't know you were paying. Rent to own, and the real price tag hiding behind that low weekly payment. And then, at the end, the thing nobody wants to say out loud about why these products cluster in the same neighborhoods, year after year. Let's go. The payday loan trap. You need $300. Car repair, medical copay, doesn't matter, you don't have it. A payday lender says, no problem. Pay us back in full, plus a fee on your next payday. $15 per 100 borrowed sounds manageable. Say it out loud, $15, and it sounds like nothing. Convert that to an annual percentage rate. It's almost 400%. Here's where it actually gets you. Payday comes. You can't pay the full amount back and cover rent, groceries, everything else that didn't pause while you were dealing with the loan. So you roll it over, pay another fee, extend it again. A $300 emergency turns into a months-long fee cycle that can cost more than the original loan ever did. And here's the part that should bother you. The industry knows this happens. The business model depends on it. A borrower who pays on time and never comes back isn't a profitable customer. The profit is in the cycle, not the loan, the cycle. The overdraft tax. This one's sneakier because it's hiding inside a product you already trust. Your own bank account. Spend more than your balance, the bank covers it, then charges you a fee. Typically, $25 to $35 per transaction. Doesn't matter if the overdraft was $4,000 or $4. A $4 coffee that triggers a $35 fee is mathematically an APR in the thousands of %. For years, a lot of banks processed your transactions largest to smallest instead of in the order they actually happened, turning one big purchase into multiple overdrafts, each one with its own fee stacked on top. Regulators have pushed back on some of the worst versions of this. The core product is still standing. And the people who overdraft the most aren't careless with money. They're living so close to the edge that one late paycheck pushes them over. They're being charged a premium for being poor. Rent-to-own, paying for the privilege. Walk into a rent-to-own store. Walk out today with a TV, a laptop, a washer, and dryer. No credit check, no big upfront payment, just a weekly number that feels manageable. What doesn't get advertised is the total. A $500 television can end up costing $1,500 or more by the final payment. Effective interest north of 100% annually. For the privilege of spreading the cost out. This one's not really about the product. People need appliances. People need a laptop for work or school. The predatory part isn't that the need is real. It's that the product is structured to extract everything it possibly can from someone who doesn't have another option. If any of this is landing, if you've lived it or watched someone you love get caught in one of these cycles, hit like right now, subscribe so the next episode actually shows up in your feed, and send this to the one person you know who needs to see the math laid out like this. This is the part of the system that runs quietly. Saying it out loud is how that stops working. Okay, let's get to what I promised you. The thing nobody says out loud. These products don't show up randomly. They cluster. Payday lenders set up in low-income neighborhoods with few competing banks nearby. Rent-to-own stores concentrate where access to real credit is thin. Overdraft fees hit hardest in the accounts of people living paycheck to paycheck. There's a term for the condition that makes all of this possible. A banking desert. A place where traditional banks have closed up or never showed up at all. And here's what I need you to actually sit with. Banking deserts are not what's left over after the market naturally moves on. They are a decision. Branches get closed and reopened and staffed and resourced based on a calculation banks run all the time. Which neighborhoods are profitable enough to serve and which ones aren't worth the overhead. When a bank closes a branch in a low-income community, that's not the bank failing to notice the neighborhood exists. That's the bank running the numbers and choosing somewhere else. And the moment the bank leaves, the financial needs of that neighborhood don't leave with it. People still need to cash a check, still need short-term cash when something breaks. Something has to fill that vacuum. What fills it is never the thing designed to build your wealth. It's the thing designed to extract it. That's the part nobody says in the boardroom, but the pattern says it for them. Predatory lending isn't an industry that targets underserved communities despite the absence of banks. It's an industry that exists because of it. The desert isn't an accident the payday lender stumbled into. The desert is the business opportunity. So here's the question worth sitting with. If financial education alone can't protect someone from an industry specifically engineered to outmaneuver them, and it can't, then is the fix really teach people better? Or does the system that allowed an entire industry to profit from someone else's absence need to be the thing that actually changes? You didn't choose your zip code's bank branches, but now you know why they're there, or why they're not. Next episode, we're going back to something we only started to unpack last time. What actually happened when pensions disappeared? We talked about the shift to the 401k briefly, but there's a number coming in that episode about what the average American actually has saved for retirement right now, at this exact moment in their career. And it is not what you think. Click the next video. You're going to want the full picture before you make another retirement decision.